50 or 100 years. This is a real thing.
Jim Grant is the editor of Grant's Interest Rate Observer and one of the country's foremost experts on credit markets. He says it didn't have to happen. That this disaster was created entirely by Wall Street itself during a time of relative prosperity. And they did it by placing a $1 trillion bet with mostly borrowed money that the riskiest mortgages in the country could be turned into gold-plated investments.
If you look at how this started with the subprime crisis, it doesn't seem to be a good bet to put your money behind the idea that people with the lowest income and the poorest credit ratings are going to be able to pay off their mortgages.
The idea that you could lend money to someone who couldn't pay it back is not an inherently attractive idea to believe in, right? However, it seemed to fly with people who were making $10 million a year.
With clients clamoring for safe investments with above-average return, the big Wall Street investment houses bought up millions of the least dependable mortgages, chopped them up into tiny bits and pieces, and repackaged them as exotic investment securities that hardly anyone could understand. But it didn't stop the rating agencies like Standard & Poor's and Moody's from certifying the dodgy securities investment grade, and it didn't stop Wall Street from making billions selling them to banks, pension funds, and other institutional investors all over the world.
The world's financial system teetered on the edge again last week, and anyone with more than a passing interest in their shrinking 401k knows it's because of a global credit crisis. It began with the collapse of the U.S. housing market, and it's been magnified worldwide by what Warren Buffett once called financial weapons of mass destruction. They're known as credit derivatives or credit default swaps, and we did a story on the multi-trillion-dollar market 3 weeks ago, but there's a lot more to tell. Essentially, they are side bets on the performance of the U.S. mortgage markets and the solvency of some of the biggest financial institutions in the world, a form of legalized gambling that allows you to wager on financial outcomes without ever having to actually buy the stocks and the bonds and the mortgages. It would have been illegal during most of the 20th century, but 8 years ago, Congress gave Wall Street an exemption, and it's turned out to have been a very bad idea.
The term derivative is almost becoming a household word.
The cat's kind of out of the bag here.
This is not the American dream. It's an American nightmare.
While Congress and the rest of the country scratched their heads trying to figure out how we got into this mess, we decided to go to Frank Partnoy, a law professor at the University of San Diego who's written a couple of books on the subject.
Can you explain to me what a derivative is?
Yes, a derivative is a financial instrument whose value is based on something else. It's basically a side bet.
What is a credit default swap?
A credit default swap is a contract between two people, one of whom is giving insurance to the other that he will be paid in the event that a financial institution or a financial instrument fails.
So it's an insurance contract.
It is an insurance contract, but they've been very careful not to call it that, because if it were insurance, it would be regulated. So they use a magic substitute word called a swap, which by virtue of federal law is deregulated.
So anybody who was nervous about buying these mortgage-backed securities, these CDOs, they would be sold a credit default swap as sort of an insurance policy.
A credit default swap was available to them, marketed to them as a risk-saving device for buying a risky financial instrument.
But there was a problem.
Oh, there was a big problem.
What was the problem?
Well, the problem was that if it were insurance, or called what it really is, the person who sold the policy would have to have capital reserves to be able to pay in the case the insurance was called upon or triggered. But because it was a swap and not insurance, there was no requirement that adequate capital reserves be put to the side.
Now, who was selling these credit default swaps?
Bear Stearns was selling them, Lehman Brothers was selling them, AIG was selling them. You know, the names we hear that are in trouble, Citigroup was selling them.
These investment banks were not only selling the securities that turned out to be terrible investments, they were selling insurance on them?
Well, it made it easier to sell the terrible investment if you could convince the buyer that not only were they going to get the investment, but insurance.
What role did the credit default swaps play in this financial
disaster.
They were the centerpiece, really. That's why the banks lost all the money. They lost all the money based on those side bets based on mortgages.
How big is the market for credit default swaps?
We really don't know. There's this voluntary survey that claims that the market is in the range of 50 to 60 or so $trillion. It's sort of alarming that in a market that big, we don't even know how big it is to within, say, $10 trillion. But
$60 trillion?
$60 trillion. I know it seems incredible.
Do you understand the TARP money that everybody hears about, right? Do you know what that TARP money, what it's for? To offset all that crap right there, right? When the first TARP money was issued, everybody's wondering, well, why is there still no liquidity? Because the banks can't loan. They can't loan. In order to be a bank, you have to have a certain amount of money in reserves. My reserves requirements, if I have an asset that I'm listing on my books to be worth $100 million, and now the market drops its value, I'm out of compliance. I'm no longer a bank. The Federal Reserve can come in and shut my doors. So in order to allow me to maintain bank status, I need more capital. On the way down, what does Citigroup do? They offered new shares at $22 a share, right? Before it bounced, it went down to $1. So what they needed to do was capitalize. Is anybody eager to buy any new offering from any bank? No. So if we're not going to do it, who's going to do it? Well, we're going to do it we're the ones that are going to pay for it.
It's called greed on both sides.
I agree with you. I agree with you. There are issues within the system, no doubt, and abuses. So now that's where the TARP money went. Keep listening on. You'll be furious by the time it's over.
4 times the size of the U.S. debt, but that's the size of the market according to these voluntary reports.
And the market's totally unregulated.
And this market is almost entirely unregulated.
When it comes to bailouts of American business, Barney Frank and the Congress may be just getting started. Nearly $2 trillion tax dollars have been shoveled into the hole that Wall Street dug, and people wonder, where's the bottom? It turns out the abyss is deeper than most people think, because there is a second mortgage shock heading for the economy. In the executive suites of Wall Street and Washington, you're beginning to hear alarm about a new wave of mortgages with strange names that are about to become all too familiar. If you thought subprimes were insanely reckless, wait till you hear what's coming.
What's the future hold? Well, this shows...
One of the best guides to the danger ahead is Whitney Tilson. He's an investment fund manager who's made such a name for himself recently that these investors, who manage about $10 billion, gathered to hear him last week. Tilson saw a year ago that subprime mortgages were just the start.
We had the greatest asset bubble in history, and now that bubble is bursting. The single biggest piece of the bubble is the U.S. mortgage market, and we're probably about halfway through the unwinding and bursting of that bubble. Halfway. It may seem like all the carnage out there, we must be almost finished, but there's still a lot of pain to come. In terms of write-downs and losses that have yet to be reckoned, checking whether the income was even real. They turned to low and no-doc loans, so-called liar's loans, and jokingly referred to as ninja loans. No income, no job, no assets, and they were still willing to lend.
But help me out here. How does that make sense for the lender? It would seem to be reckless in the extreme.
It was, but the key assumption underlying the willingness to do this was that home prices would keep going up forever. And in fact, home prices nationwide had never declined since the Great Depression. Defaults right now are incredibly high at unprecedented levels, and there's no evidence that the default rate is tapering off. Those defaults almost inevitably are leading to foreclosures and homes being auctioned and home prices continuing to fall.
What you seem to be saying is that there is a very predictable time bomb effect here.
Exactly. I mean, you can look back at what was written in 05 and 07. You can look at the reset dates. You can look at the current default rates, and it's really very clear and predictable what's going to happen here.
Just look at this projection from the investment bank of Credit Suisse. These are the billions of dollars in subprime mortgages that reset last year and this year. Now look at what hasn't hit yet. The Alt-A and Option Arm resets when homeowners will pay higher interest rates in the next 3 years. We're at the beginning of a second wave.
How big is the potential damage from the Alt-A's compared to what we just saw in the subprimes?
Well, the subprime